What's driving markets? Welcome to Market Take. Each week we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Vivek Paul, head of the portfolio research team at the BlackRock Investment Institute. This week we're going to discuss our latest strategic views. In this volatile economic regime, we stay dynamic on a strategic horizon of 5 years or more to take advantage of valuation-driven opportunities. While valuations may not always drive short-term results, they are pivotal over the longer term. Our granular approach targets areas we see as having comparatively attractive valuations, like emerging market equity, where we go overweight for the first time since 2020. We see broad emerging market stock valuations as attractive. We look at the equity risk premium, a key valuation metric, which shows emerging market equities at the cheapest relative valuations to developed markets in nearly 4 years. We see opportunities in Mexico, India, and Saudi Arabia, countries that we see at the cross-current of many megaforces. These structural shifts, like geopolitical fragmentation and demographic divergence, are driving returns now and far into the future. Emerging markets rich in natural resources and supply chain inputs stand to benefit in this geopolitical environment, turning them into multi-aligned trading partners. Diverging global populations favor most emerging markets, where having a growing domestic working age population supports economic growth, over developed markets with flat or shrinking worker pools. We remain neutral developed market stocks and stay selective, with a preference for Japan. The long-awaited comeback of inflation in Japan brightens the outlook for corporate profits, as companies can raise prices on products and services while rising wages are set to support consumer spending. Ongoing corporate reforms aimed at boosting shareholder value also underscore our strategic preference for Japan. We're overweight developed market government bonds for the first time in over 4 years, notably in short-dated and long-dated bonds outside of the US. Heightened market sensitivity to economic data releases has driven market volatility so far this year, especially in government bonds. Last week's US CPI print showed inflation slowing as expected. In a whole portfolio context, we go underweight investment-grade credit, given tight spreads. We still see inflation getting closer to 3% over the long run, which we do not see priced into fixed income markets. That underpins our strategic preference for inflation-linked bonds. The path for inflation and central bank policy from here will vary by region. We expect policy rates to fall more in the UK than in the US. This dynamic makes UK government bond yields more attractive than other developed market debt. That's why we like long-dated developed market government bonds outside of the US, such as UK gilts. Yet we keep our preference of short-dated over longer-dated maturities across developed markets. Here's our market take. We see the new macro regime of greater volatility causing more frequent valuation shifts between asset classes. Valuations may not always drive short-term results, but they matter over the long term. We believe staying dynamic, even on a strategic horizon of 5 years and longer, creates opportunities to maximize investments as these shifts take place. We prefer emerging markets over developed market equities, given relative valuations, but stay selective in both. We like inflation-linked bonds in a high-for-longer rate regime. We now favour developed market government bonds over investment-grade credit, driven by our preference for UK gilts. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to The Market Take wherever you get your podcasts.
This material is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com